Hey guys, it's October the 14th, Friday. And again, we're just going to have a really volatile and crazy market. Now, today I'm going to talk about bank earnings because a bunch of them came out. And I don't care how the market's reacting because this was largely speaking not good in some ways. I mean, this is just really crazy how things are reacting versus what actually the banks were saying. And I still have to process some of them, but wow. Interesting. All right, let's get into it a bit this afternoon. Past performance is not indicative of future returns. We have, it's just been a really crazy time. Retail sales came out weak. So, that is what it is. We kind of knew that was going to happen in a lot of ways. So I'm actually surprised that anyone is confused at all as to what's going on. But we had Citi, JP Morgan, US Bank, Wells Fargo, UNH, Morgan Stanley, and FRC report this morning. And you would think when we look at FinViz and see like all these banks up that all of them did great. And that's just not true. With all due respect. Now, it's actually whether or not they beat estimates, but given the nature of it, and then everything else is red on the screen, including energy, which is just every other day people are doing strange gamesmanship there. We had mentioned that we would see volatility until musical chairs stopped, and that musical chairs really has to stop as we get into the colder months. So, really watch that weather report because that's what actually dictates when people are tired of playing musical chairs. Even the bank CEOs are telling you there's an energy issue. So gosh, it's just really, really fascinating. And as a result, you want to have capital on hand to take advantage of buying very specific names. Okay. Do not be arbitrarily buying this market right this minute because it's a little bit dangerous to do so. Let me show you what the bank said and the implications associated with it. UNH, I would say, is the one company that truly clean, crystal clear. The healthcare providers are wonderful, are doing wonderfully. And that just has to do with the fact that the bigger piece of who pays them is employers. And as we know from the jobless numbers, there have been more people to bring on staff, and that is what it is. Okay, next week is a huge earnings week. We have the rest of the financials coming out throughout the entire week. By the way, this isn't even a complete list. It's just, I'm using Earnings Whisper, that website, to just start layering in this weekend. I usually add a few more names because Earnings Whisper oftentimes has the same problem I have, which is just trying to double check that the the dates are actually correct and that the banks, or excuse me, that the companies haven't changed the date that they would like to report. Okay, let's get into it. JP Morgan. Okay, I mean, it was maybe better than some people expected. Okay, first and foremost, here, I'll stop share for a second. First and foremost, what you have to understand about banks is that what we're seeing here in the first and foremost, what the intelligence that they gave us this quarter had less, in my opinion, value on what's going on with them and more value in what's going on in the global markets. JP Morgan, none of the banks did well. Let's just call it what it is. None of them did well, if we're going to be really honest about it, but it's relative good and bad. And to the extent that they just earned less versus they took a book value hit. Okay, so that's what we're really looking for this quarter more than anything. JP Morgan was interesting because Jaimie Dimon did come out and talk about how problematic the world is, and then people sold it off so aggressively thinking that he was telegraphing. He doesn't do that ever. And we kind of spoke to that a bit. So it's always hard. I don't think you ignore what he has to say from investment process, but you do really want to be careful taking his words and mapping it to JP Morgan's earnings. For whatever reason, it just never works out. It's never worked out for me. So whenever he says something that is the opposite of what I think he should have been saying, I usually just back out of that stock. And in the morning, we saw a heavy rally on all financials because JP Morgan's conference call, quite frankly, was first, for lack of a better way to describe it. Okay, I mean, it's the first one that actually mattered. There might have been some other people that reported at 8 a.m. and had a call. But when we look at the numbers, net interest margins, net revenues up 10% was great. But then we're down 17% on net income. Okay. I actually think that for them, this is okay. So JP Morgan is a case of we protected capital. We did not do things that were too crazy. So you got great net interest margins, which we knew we needed for other parts of the bank. That's how I interpret what he was saying the other day. What he was saying would be like their tactics going forward, and what he was really reporting and witnessing that needed to be communicated to his clients, not necessarily to his investors. Okay. Let me go through a couple of things that he's seeing. Home lending grinding to a halt. Auto lending also declining a bit for him because, and this is really important because even though it's up 9, there were a lack of cars. Okay. Now, if you contrast what he's saying to Wells Fargo, which I've not had a chance to listen to the call yet, in fairness, but I'm just looking at the notes that they have thus far. I think what he's doing is he's refusing to write bad loans on cars, because that game, he was alive for the last few times that game has been played. And even though the home loan decline means that part, he'd rather make up for it in consumer and business banking than he would in being too aggressive on the auto loans. That's how I'm interpreting the game tactics that he's taking. Now, non-interest expense was up. It was up for everybody, but this is not nearly as bad as it was up for others. So there's something really brilliant about that. And that's despite the fact that people were on him about the fact that he's continuing to hire talent in this marketplace. I think, and that is actually one of the funnier parts of the call. This guy gives this big, long question. Hey, do you still hire? Why wouldn't you just wait until if the market corrects? And he's like, yeah, I'm not going to do that. Essentially, I mean, I think he said it a little bit nicer than that, but you can listen to that part of the call. It's towards the end. It was really funny, in my opinion. Okay. The investment banking business is weak. Okay. And as bad as this was, this isn't nearly as bad as we saw at Morgan Stanley, because he didn't take anything too crazy here, in my opinion. Net revenue was down. The market and securities business made up a bit for the banking business. That is because they are the strongest player in fixed income. I'm just going to say it. There's other people that may feel differently, but this JP Morgan is a fixed income house, and fixed income across every business line was strong, except for BlackRock, right? So that's part of the reason why yesterday I'm like, there's nothing that should make you stoked about BlackRock yesterday, but be that as it may. In fairness to BlackRock, though, not to be too aggressive, it is the case that they are going to get asset inflows from fixed income because, they run a really good business. Rick Reeder's really smart over there. And so I don't think it's, but nonetheless, you got to compensate for the other parts of the bank or the other parts of the asset manager that are just not doing it for you. So here, if you dig through the numbers, you'll also see that the equities business was weak. Now, it could have been a lot worse because just look at the markets, but it was weak. The provision for credit losses that he's taken, he got a lot of questions on, but the fact is, as I had mentioned before, they took more provisions than anyone else going into COVID. So that's going to look like a very different number. The commercial banking business was fine. But they are provisioning more, and that's what's actually dragging it out. Corporate, the other thing that I want to talk about, let's see, was there one other thing I wanted to talk about? Yeah, on the wealth management business, they actually did okay, which is an intriguing thing because I think, the way that they described it was really unique. They said because they had to take some credit losses, they actually forced them to release reserves, and the way that nets out allowed them to do well. I have to investigate further because I'm not familiar with exactly how that works, to be honest, but it is some strange flow of capital. That said, I got to say, he is playing a very particular strategic game, because one of the biggest things he talked about was the fact that people should not be confused that even though they're holding 13% CET capital ratio, they're prepared to take risk if the market does something truly stupid, like puke out assets at a really great discount. And there was a lot of conversation about Bank of England, but I don't think they were on the wrong side of that trade, whereas clearly BlackRock was in some particular circumstances. Now, I don't think they were massively on the wrong side of the trade for BlackRock, so I wouldn't go too crazy there. But I don't think JP Morgan got hit as much as some of the others in the space did. Morgan Stanley maybe got hit a little bit, but that tells me that if none of these guys got hit, it's the European, like I am worried about the European banks. Again, I don't cover Europe, so that might just be good for me as far as that goes. If you're a true banking analyst, and that's kind of the thing, I'm not seeing the collateral move that was resulting from the Bank of England's very fast situation being a problem for these guys. And also, especially with, well, a little bit with Morgan Stanley, but definitely with JP Morgan, they talked a lot about the fact that they really were going to, with the new Basel IV plus some other things, they were hypersensitive to thinking about how to hold enough capital correctly and do it in a way that's thoughtful. But they've got, like I said, a CET holding of about 13%. So they are, I don't want to call it over reserved because you can't almost over reserve enough. Now, let me show you Morgan Stanley and how that's different. Morgan Stanley revenue down 12% year over year. It looks like a little bit more of a modest slowdown if you just go sequentially on the quarter. We have a little bit more provision for credit losses, not too crazy. Net income down 28%. Now, they don't have the commercial banking business in the same ratios, if you will, like, right. If you know, it's a little bit of a different business at Morgan Stanley. So the securities business, which you can see investment banking is a huge component of, clobbered, right? And then equities down a touch, fixed income, like I said, doing well for everyone that has that business. Remember, they are integrating E-Trade. So that actually, in some ways, helped them as far as the way that capital is reserved at an E-Trade because of the E-Trade bank versus them being an investment bank. So it's really fascinating. The strategic things that they did in the past are mixing in a way that's probably very unexpected and will take bank analysts a time to digest. Here's what I want to show you that I think is phenomenal about Morgan Stanley. Despite this, and the fact that they're taking a 30% down almost in net income, very little changed in book value. And that's, to me, pretty impressive given the business specifically that they're in and given how it's going on there. Citibank, let's go to Citibank. Oh wait, one other thing. I just want to show you as well. This is part of why I feel the way I feel. Look at how vast and aggressively the revenues are changing across the various businesses. And then you can see how high expenses are. Full props for getting your expenses down and not having a huge impact from the quarter previous to now. This is like pretty phenomenal, right? Because remember, the way that this is going to look cosmetically could, anyways, you got me. Like, does it need to go down faster? Yeah, because the expenses are, revenues are coming down pretty fast, but you still got to give them full props for that, in my opinion, because it does demonstrate some operating ability in a weak market. So I'm not worried so much about Morgan Stanley. The only thing that kind of bothered me was this CET capital decline, let's call it. So, you had kind of a big change here. And it just kind of depends on how you're thinking about the market going forward. And it is impossible to know what cards they're holding currently as to why they might be reserving the way that they're reserving. They have been reserving more than most throughout this entire situation crisis. And I think that's the right call. I would also say that the thing that I don't love is this share buyback. It's pretty aggressive, quite frankly. And I think they could take the foot off the gas there a little bit, but it is less than where they were at last year this time. So there's that. And then they have low tax rate. But Morgan Stanley so far looks okay. Now, both Morgan Stanley and Jaimie Dimon seem to be suggesting that someone out there potentially has a bag that they're holding, and the stuff in the bag, just in case you're not an American English speaker, that's not good. You don't want to be holding the bag, okay? But it seemed to me that they were suggesting in both calls that they are worried that someone's holding a bag. And that's, as a result, some of the things that they're doing to kind of like motor down the banks a bit as we go in the fourth quarter and the first quarter. Now, Jaimie Dimon also spoke a lot about the timing of debt-related situations, which is, so people asked him, well, how is this different from the past? He's like, look, we're just getting closer to the event. It's not that I'm really changing my thought process. We're closer to the event. I have a little bit more visibility. So it's a little bit more, we got to be nimble. We got to kind of, these are my words, listen to the call and see if you don't agree with me. But both of the calls left me feeling like, wow, they're worried that something out there is going to come. This 100 basis point move was something that I think JP Morgan kind of did in a beautiful, elegant way. Morgan Stanley maybe ever so slightly less, but still, because they're reserving at 16% going into the quarter, you can kind of see what's going on. Now, Citi is a different scenario. Citi is trading at half book value, okay? And so all the way you think about it is totally different. And, the one thing with Jane Fraser, as much as I am a fan, okay, let's be clear, I'm a fan. I think she's doing great. That said, for all folks, this will be I think she is getting a little lucky here because her whole deal has been winding down these businesses. If you ask me how the core business is doing, let's face it, it's not doing great. And they talked about the fact that they believe, okay, let me just show you. Here's revenue up 6%, operating expenses up 8%, income from continuing operations, though, down 25%. Okay, realize that I'm going to show you the legacy business. What they're calling legacy business is all the banks that they've been exiting internationally, of which is the Philippines. If it had not been for the Philippines sale, essentially is what they're saying, then you would have actually had a very, these numbers would not look like this, for lack of a better way to say it, because they took a huge gain on that sale. Now, they are building up provisions. Their CET capital ratio right now is about 12%. I don't know why I didn't put it on here. But it's a very confusing quarter, because when we look, they're talking about the fact that they're gaining wallet share. And then one of the analysts pushed them on. They're like, what? Can you just double check? What do you mean by you're gaining market share? Because when we look at the income from continuing operations, we have a down 30% in ICG, institutional client group, includes the investment banking business. It includes some of the other markets businesses, right? So that's down 30%. We just saw what Morgan Stanley's was, and we saw what JP Morgan's was. And remember that Citi had, in theory, historically has been a bigger fixed income fixed income house. So they should have came in right between Morgan Stanley and JP Morgan, given the mix of how they do in the markets. But this is down 30, but down 45% on the quarter. And then personal banking, wealth management down 58%. Now it's saying up 43% on a quarter. So in fairness, this is supposed to only be continuing operations. So I don't 100% understand what's going on here. And then the legacy business, you can see it doesn't matter because they're going away. But when we look at this, it's just really very confusing. What I would give her credit on is that we do see very little movement on book value, which is kind of what she's trying to do and she has a mandate to do, which is just get rid of all these things. But it's also really hard to see how she's navigating the markets component of the business. And maybe it won't matter because of the way she's winding it down. Maybe it will, it's hard to say, but I gotta say Citi is really confusing. They're lucky though, because they're trading at half of book value. So I think that might be adequate buffer. It's a very weird thing, but I would say, let's see. Yeah, the two really odd phrasings in the call that left me with that was interesting is really Jaimie Dimon saying, we sell things we don't want to own. We'll buy things we do want to own. And it really sounded like he's transitioning. He's transitioning the portfolio, and he's telegraphing very aggressively that if we do have any kind of fire sale, they do have the capital to do something about it. With Citibank, this concept of market share and wallet share wasn't well articulated. I'd love to see a little more there, because I think that I'm not the only one that was left confused, given what we're seeing in continuing operations, the wind down of various businesses. And are they thinking in terms of wallet share as relates to, they were saying total spend by a corporation, without them doing a lot more investment banking business with them. I'm not sure how they're thinking about that concept. And with that, I'll go ahead. One other thing, Wells Fargo, this thing is trading up. It now trades at about a little bit over 1x book value. So, I've got to listen to calls, so I will do more on this next week, but this was not a good earnings report. And I'm just going to show you really quickly, just straight off of their report, why that is. Here, let me share screen. If we look at this, you can also see this really aggressive slowdown. So first of all, here's their numbers. you can see that net income was down significantly, 3.5 versus 5.1. And that's 100% due to expense increases and a need to increase for provision losses. Now, Wells Fargo has had this entire time the lowest CET capital ratios, but they have less exposure internationally, things like that. So I was like, this one's a hard one to call. But so here's their CET capital ratio situation, really largely speaking, unchanged, but we are taking it at a higher net interest, net loan charge-offs, et cetera. I think the thing that really bothers me as well is this right here. Let me increase the size of this. If you look at this, home lending business is grinding aggressively down. And they're going to make up for some of that with small business lending. That, like we said at JP Morgan, is probably fine. But then their autos business, it's like, I don't understand the mix of how people are thinking about how this is going to go. And then you do have a lower CET capital ratio. So I really want to do a bit more work here, but I'm not thrilled with how this is going, because most of their loan increase kind of looks like it's just balances that are increasing in size because people aren't paying them off. And with that, I'll just go ahead and take questions at this point.
Hey, Miss David. Could you please elaborate for your viewers what you mean by holding the bag?
Oh, no, it's like, I think, it sounds like somebody has taken risk in a particular way, that there is a concern by these banks such that they would rather run more conservatively. What do I mean by more conservatively? The CET capital ratio gives you a really good sense for, the CEO's thought process on whether there's a potential problem in the system, like a systemic risk. JP Morgan probably spoke about it the most on their call, where they weren't sure where it was going to come from. And this was in response to the questions related to the 100 basis point shift by the Bank of England and what that implied as relates to collateral charges, et cetera. I think that given this environment, these guys are really smart. They can never tell us everything that they know, obviously, because there's all kinds of client confidentiality I'm sure they're going through. And I know that sounds very ominous, but the fact is they are seeing a world where they just want to have more cash on hand just in case someone really pukes out their portfolio, or some emerging market country has a real issue for which somebody else holds that debt in exactly the wrong way, all of that stuff. Yeah, I don't know if that fully articulates it, but they're worried still that their event risk is very high.
Okay, Jaimie Dimon, when is this quiet period? Is it 10 days, 2 weeks?
I mean, it's the same as everyone else as far as that goes. Why is it just because he spoke the other day?
Yeah,
he does it systematically. I'm not even sure why.
But he knows what earnings are.
Yeah, that's why, we talked about that the other day, and I'm like, I can't every single time. I have no idea why, but if you go back quarter after quarter after quarter, he has said one thing, and then the bank has literally reported the opposite every time. And it's very frustrating if you are a news flow related trader.
All right. So don't trade it. Period.
Yeah, you can't trade. He comes out almost like systematically a week before earnings and says something. I don't know if he has like a group that he's talking to and people just want to take a quote or what. That said, I would say the one thing about this quarter that was really fascinating for me is that ever since he had his heart surgery right on top of the first quarter that they needed to report earnings post-COVID, everyone has thought that he would retire. And he put out that big annual letter that really made all of us think, man, this guy's done. He just doesn't want to do this anymore. And the one thing that I thought was really fascinating about this call was that he spoke a lot. Now, no shade to the CFO, because I actually think that more than any other quarter, the CFO actually did a great job discussing the state of affairs at JP Morgan and what they were going to do. I actually think he's doing a better job than most. Let me say it that way. Nonetheless, Jaimie Dimon spoke and answered most of the questions this quarter. I think that kind of indicates that this market environment, even in his mind, is not one where you can pass the baton. It's not
Okay,
fair,
gotcha.
in other
I've
words.
seen him, you would think, he's the largest bank in the world. You would think he has a handle on interest rates. I've seen him be exactly 100% wrong on the direction of interest rates. I mean, it's amazing to me. And maybe he does it on purpose. I don't know, but to me, it's bad PR. Anyway, high five to you on Domino's.
Yeah. That
Domino's,
was, I don't even feel that as special for it. That was such a bad quarter. I
why
mean,
not? But you called it. You called it, and the next day it's down 13 points. I mean, that's amazing.
yeah. Here's the thing with Domino's. When I looked at the earnings, first of all, I love the CEO of Domino's. I think he is a phenomenal leader, period. I really admire the way he thinks about his staff, the way he's not going to like make his staff suffer just because it's worth $1 to him. It's not interesting to him to do that. Nonetheless, he is in a very tough operating environment for what he's doing. He's seeing labor costs increase. He does still, despite the fact that Domino's is a little bit more expensive than some of the other quick service restaurants, he does have to provide value in a highly competitive market. And also he's making pizza. Pizza's biggest input cost is exactly what we know we have a problem with right now, which is the cost of wheat.
Right.
So he knows that he's got inflation. Strangely enough, he didn't want to talk about inflation on the call. And also the other thing that one of the very, it's so funny because everybody on that call definitely follows his lead in showing a modicum of gentlemanliness, let's call it that way. So he was very politely asked, hey, so, I noticed that you were discounting still since September, and it seems like a month later, we're still discounting. And that's really difficult on margins. Can you talk about, strategically why that is and what that implies for operating margins going forward, or what strategically you're trying to do? And he gave an answer that really, I don't think was an answer. So it was, it was really easy to know that, when you look at all of it like that, you should not expect great earnings from Domino's, not just for this quarter, but probably for a couple quarters to come, because of how he will try to navigate this situation best as possible. So my suspicion
Look
is,
at numbers. The numbers didn't lie. So,
yeah.
I'm just saying, great call.
Oh, sorry. That was long-winded.
Tesla's earnings are Wednesday.
Yeah.
And you'd mentioned that car sales were up. Where did you see that?
CPI, yeah, new car sales and CPI are good. My issue with Tesla, I'm out of Tesla at this point, even though I do think that at these levels it's a buy. So if you've got a longer horizon, if you're doing it by buying the stock because you want to own it for the long term, this is an amazing entry point,
right,
relative to its growth rate, et cetera. But the volatility is going to be so crazy. I just want to be out of it a little bit from the options perspective. And then if I get an opportunity, I'll come in, because the bears are on top of this in a way that I think is quite frankly ridiculous, but I'm not going to fight the tape. There's more momentum traders than there are fundamental traders. And so they absolutely have the ability to overwhelm. Here's the deal. That thing is trading at 50% of its PE to growth, right? So, and if China opens up, that thing will spit higher so fast that the shorts will have their face ripped off, for lack of a better way to describe it. It really is the best way to describe it. That said, again, there are more momentum traders than there are fundamental traders. So only for that reason, am I out of it? Yeah.
But momentum are intraday mostly.
Oh man, it's good. Maybe, yeah.
Yeah, but fundamentally it's good.
It's so crazy too, because, all the fundamental people were so aggressive as relates to Tesla, when Tesla wasn't earning a lot and still had to prove that it could grow into these earnings, into this valuation. Where are they now is what I'd like to actually say, because I wasn't even antagonistic. I was like, oh, this is a growth stock. It's really hard to do that work. That from given my particular skill set. So I'm going to not say anything and admire and watch whether or not this guy, who has, by the way, infinite access to capital. I mean, that he's demonstrated, period. Just look at how he funds himself versus how the other autos fund themselves. So I'm like, you know what? I admire him. He definitely is doing business in a way that I'm not accustomed to. But now, if you look at the numbers, where are you, other fundamental people? Make an actual comment. Have some cojones. Don't just have cojones and to short a stock. It's ridiculous. Do you know what I mean?
Right. Well, NIO, which is the Chinese EV maker, it's at 12 from, I mean, something's going on. I mean, China is seriously, I don't know, 1203 down from 77.
I mean, I've taken a look. I don't know that stock as well, so I can't really speak to it.
No. I just mean the overall Chinese economy.
Well, okay, the Chinese, it's a real, okay, so is the Chinese economy weak? Yeah, it is. We've been talking about that for a while, right? Is the Chinese economy experiencing inflation? Turns out they're only experiencing low single digits. Did the Chinese government stockpile the things that they need? I think there's a better than 50% chance they did. So if they decide to open up, they could legit do it.
Well, when is he confirmed as the leader?
October. So it's usually the first thing they do, I believe, at the congressional meeting, which starts on October the 16th. So, for us, there's 12 hours difference, but it'll be after today. And then we'll know. But then remember, the CCP then makes a whole series of decisions. He's not like, look, does he have consolidated power? Yes, he does. I mean, unless something really bizarre happens in the next 24 hours. Do we have any real clue which direction he's going to go out of this? I got no clue. And it's really opinion. I mean, I guess there are some people that just know him even better. I'll totally give it to you. I don't mind if you're just smarter than me, I'll give it to you. But for the layman, for the average person, we can all conjecture. We won't know until the CCP starts saying it. And then we'll know very quickly.
But you mentioned this before. If China opens up, which they will eventually, that's very friendly for inflation,
That's
right?
right.
Okay.
Sorry, I interrupted you. Is it friendly for inflation? It'll help Europe.
Well, they have the biggest problem, right? Okay.
It'll help Europe, and then it'll take some pressure off of us trying to help Europe. Because here's the thing, if the market trades down because China decides to help all of us out by helping Europe out, I think that's the wrong call by the markets, because the fact is they don't produce enough oil to be allowing that fuel source to go. Europe has some wood to chop as far as how it wants to think about its energy future, because I think this desire to believe that they can very quickly switch to emerging, I'm going to call it emerging technologies, because that's what it really is, right? All of this wind, solar, et cetera, it's all emerging technology in the sense that it needs to be built out. It needs to, at scale. And also, by the way, maintenance at scale. Right now, one or the other is very expensive, okay? And then there's this weirdness for them as relates to nuclear, which would be the only real solution given where natural fuel, well, given where everything lays out, right? Because even if you're building a windmill, Cervantes style, right? You still have to stick aggregates in it, which is the thing that actually makes the cement. I don't think they have to, where are they getting that from? And then where are they getting the energy to then turn it into, these things aren't a zero energy cost. All these things in building aren't a zero energy cost. And they don't want to burn coal. The continent itself does not make enough oil. And even if you added in the other European countries, you still are, if you took all of Europe, including Norway, which does export a lot of oil, the UK, which depending on how they decide to deal their deal, could be an exporter of oil in a given year at a certain price, and the Netherlands, you don't have enough, right? Just look at the numbers. And so this grand experiment, it's going to be, they're going to have to come to terms with coal for a little bit, or they're going to have to resolve, take the devil's resolution, for lack of a better way to say it.
Got it. Well, I mean, the market made a huge move yesterday from a low that I think is very important, and it seems to be able to sense really good news in the future before it's ever out, in the press. So I'm thinking that may be China.
You mean on Tesla?
I'm not saying buy Chinese stocks. I'm just saying if they start to open up, this, like you said, the market should take off.
Yeah, your biggest, to me, part of one of the stocks that I think, we have. So one of the stocks that we did a video on a while back was MGM. MGM 100% is one of the biggest beneficiaries of a China reopening. And so I am a little bit farther back long MGM. By the way, too, they actually did a decent quarter this last quarter. So MGM is from a valuation perspective interesting, and from a China reopening interesting. Now that said, if China decides to do something else, it's a little bit awkward. The other thing China could do is just allow more travel to Macau, which they're not doing currently. So it doesn't even have to be a full reopening, mind you. It could just be a reopening that opens up Macau and allows people to go to Singapore.
Yes, absolutely. 3071 MGM. Asians love to gamble, I'll tell you that for sure.
To me, the really amazing thing is how well the casinos in the US have done without their Chinese. I mean, like the casinos 100% have people that fly people in from Hong Kong, Singapore, China. Let's not be confused. I'm 100% sure that they do that. In fact, I used to have a friend that was employed to do specifically that. So,
they're very good at it also.
Yeah.
Okay. Thank you, May.
All right. Good luck in these markets. Good luck next week.